We have a lot of cool events planned for our consistent members next semester. We're going to give you a little sneak peek next week, but there's some pretty exciting things, so definitely keep coming consistently. I'm sure you'll learn something out of it, and you might get some nice rewards next semester. But anyways, today we're talking about stock valuation, and then 2 days ago we're like, shoot, maybe we should include crypto. Everyone's thinking about crypto. So Max did some cram research on that and has a lot to present on crypto, but let's get right into it. So I don't know who's following the S&P 500, but last week the markets were down about 2%. Obviously, 2 weeks ago we saw Trump win the election. Markets responded very, very positively to that news. They were booming, crypto was booming, stock market was booming, everything was booming. What I like to say is every market reaction is an overreaction. I think I've said this a couple times throughout this semester. Whenever we have some big news, it's always an overreaction. Whether it's earnings, whether it's election, whether it's, I don't know, CrowdStrike, whatever it is, it's always an overreaction. We saw that exact thing with the election. Following Trump's win, the stock market skyrocketed. The next week, it's down 2%. So the market overreacted from Trump's win, and now it is resurfacing, and it fell down about 2%. So let's look at some of the significant things that happened in the past couple weeks. Last week, Jerome Powell spoke about the future of the interest rates. So a couple weeks ago, we spoke about the Fed rate cuts. Obviously, we're in a time of strong economic growth. The economy's strong. People were concerned about a recession a couple months ago. That fear is almost gone. One thing with the rate cuts that I mentioned as a risk a couple weeks ago in our interest rates meeting, when we cut the rates by 50 basis points or 25 basis points, it might overstimulate the economy. So with lower interest rates, investors or consumers can borrow more money and put it back into the economy. So I can get a loan for cheaper, so now I can go spend some more money in the economy. Since I'm spending more, what does this do to inflation? It drives inflation up. So the Fed's goal was to get inflation to that 2% target. Now that the rates were cut by 50 basis points and 25 basis points, people are spending more and inflation is actually going up. We saw the CPI up 0.2% in October to 2.6%. So the Fed's goal is 2%, but actually the inflation is going up to 2.6% in the past month. So this was pretty bad news for the FOMC. They're still expected to cut interest rates by 25 basis points in the December meeting, but now there's increased bets that they won't cut their interest rates. So there's still a 60% chance that the Fed is going to cut interest rates in the December 18th meeting, but now there's a 40% chance that we don't. Since we're still 60% favored to cut interest rates, if the Fed happens not to cut the interest rates in December, how will the markets react? We're expecting something. If we don't get it, the markets might react poorly. So this will definitely be something to keep an eye out for. But even rate cuts going forward, Jerome Powell said he's going to be cautious about cutting the rates going forward. I don't remember if you remember the last PPM meeting a couple weeks ago. We talked about the interest rates. We said they're going to cut it by 25 basis points in November, which happened, 25 basis points in December, which we don't know is going to happen, and then throughout all of next year and 2026 as well. Now with Jerome Powell saying we need to be cautious because inflation is rising, how might that change? So we definitely need to keep an eye out for that. Another significant event this week is NVIDIA earnings. So normally I don't really highlight earnings as part of the club meetings because earnings are not that big of a deal. It happens 4 times a year. But NVIDIA, obviously largest company in the world by market cap, and it's the last of the Magnificent 7 stocks to report earnings. So if you're not familiar with the Magnificent 7, it's the 7 largest tech companies in the United States. So NVIDIA is the last of them to report their earnings, and NVIDIA is the largest company by market cap in the world. So some key things to keep an eye out for on this earnings call on Wednesday is the upcoming Blackwell chip. If you're not familiar with NVIDIA, they're in the works of creating a Blackwell chip, which is the most advanced chip that they'll produce. So this chip, I believe, is 5 times as powerful as the previous chip they had. So NVIDIA is already the largest company in the world with their current chip. Now they're expected to produce a chip that's 5 times as powerful. This is really, really big news, and everyone is going to be looking to buy this. So the black hole chip is something that's definitely going to be really exciting. The next thing to consider is Trump levying tariffs against Taiwan and China. So NVIDIA imports a lot of its products from Taiwan. With Trump levying these tariffs, now will it cost more for NVIDIA? Or now will they have to open production hubs in the US? This will definitely be a concern, and Jensen Huang, NVIDIA's CEO, is going to speak about this on the earnings call. So these are 2 main things that we need to keep an eye out for. It's not just are they beating revenue, are they beating earnings per share, but it's also what is the future of their Blackwell chip? What is the future of Trump's levying tariffs going to impact their business as a whole? So we need to keep an eye out for these 2 things. Now, what a lot of you are here for today, cryptocurrency. I know Pranav loves crypto. I'm not a crypto expert. I don't hold any crypto at the moment. I used to, but crypto is booming right now. Max has done a lot of research on this. If you don't know, crypto reacted very, very positively to Trump winning the election. As you can see in the last week, Bitcoin up 20%, Ethereum 7%, Solana 9%. A lot of these big names all are green, green, green. Crypto is reacting really, really positively. So let's take a look into what is crypto, how does it work, why is it doing so well, and what are some risks we need to consider in the future?
Yeah, and so the first thing when you want to invest in crypto is really understanding what exactly is cryptocurrency. So the exact definition is pretty much a digital currency that uses cryptography, decentralized networks, and blockchain technology. Now, the original founding of Bitcoin was by someone that pretended to be Satoshi Nakamoto, because they published it anonymously, but that was their pseudonym that they published it under. And it was made in 2009 after the 2008 market crisis, which if you don't know, was when the housing bubble popped and a lot of banks went out of business because people got scared and lost a lot of money. And so the purpose of Bitcoin is to solve that issue, this issue of centralized banking. That every time you need to make a digital transaction, you have to go through your bank, and your bank has to verify it, and then you can go through with your transaction. But then comes a lot of issues like, what if the bank messes up? What if you ask to withdraw money that you don't have, and somehow it does go through, and then there's always a lot of issues that way, and banks are consistently always have a small percentage of errors in their account that way. And so the idea of Bitcoin is that instead of using a bank, they rely on a large network of computers to verify these transactions. And the network of computers consists of people, and instead of going through a bank. And so the last thing about Bitcoin is that it's founded on blockchain technology. Now in 2009, blockchain technology was really new, and it was only after the inventor of Bitcoin published his papers that people started to learn more about blockchain and what exactly it does. And in the next slide, we'll go over a little bit more about how Bitcoin, the process of buying a Bitcoin.
Yeah, a lot of this stuff is super confusing, fair warning. So I'm going to be asking Max a lot of questions throughout this presentation. Just jump in, ask any questions if you have. You don't have to raise your hand or any of that bullshit. So just jump in if you have any questions.
Yeah, so if you look on this infographic, so when you first make your transaction through something like Coinbase, Robinhood, or any of these crypto exchanges, it'll send your transaction through the peer-to-peer network, which is a large network of computers that are meant for verifying these kind of Bitcoin transactions. And so it'll go through a process called validation, in where these computers basically cross-check all the transactions and receipts with each other. Because essentially on every single computer, they're going to have a copy of the receipts, and that way when everyone's checking each other, the receipts can be verified, and you can only make transactions that are valid. And part of this is the crypto part. The only thing about peer-to-peer is that if you have all this data and information on other people's devices, well, how can you be sure that it's not going to get stolen? Well, that's where encryption comes in. It uses a lot of high-level math that I'm not really going to explain into detail here, but you just need to know that basically the algorithm, every single person that makes a transaction has their own private key, and you're not able to go backwards. You have a digital signature that you can put on every transaction, and this is mathematically impossible for someone else to forge reasonably. So it is safe. And this goes on to the next step, which is essentially the blockchain technology. Now I'm going to go into it a little bit more in detail in the next slide, but all you need to know is that blockchain is essentially a chain of your receipts, and for every receipt that's put on, it becomes more and more trustworthy. And then finally, of course, your transaction will go through to the other end, probably someone else's Bitcoin address or their wallet. Now, if you go to the next slide.
So Max, you mentioned the unique keys. How likely is it for that Bitcoin or different cryptocurrency to occur?
Yeah, so pretty much the math behind it is, I believe it's 1 in 2 to the 256 possibility of getting your key cracked, which is like, it's a ridiculously large number. It doesn't even have a name, but like it's very, very not likely. And with more and more transactions that happen, there's even a less likely chance. And we'll go into more detail on the next slide.
Probably can't brute force that.
Yeah. And so this is blockchain. So blockchain technology, it sounds very complicated, and if you really want to get into it, it's going to take a lot of work. There's classes made just for that. But in a simple term, it's a bunch of receipts stacked on each other. It's best to imagine it, like the name suggests, with a bunch of blocks. So in each block, you have two main important pieces of data. Obviously, there's a little more, but the two important ones are the hash and your transaction. So when you make a transaction, it gets put on the block, and then the hash is essentially your code, your like encrypted data. So in order to get a hash, you use your private key, and it'll go through this algorithm, and it'll produce a hash that only you can produce from your signature, so you know that no one else can do it. And once it's in the block, then it becomes verified, and then other computers in the network will basically verify it. And with more and more transactions, the blocks are connected like this. They're basically stacked on each other. So in order for someone to verify this first block, they first have to verify this block and the block on top of that. So by the time you get to this block, whatever transaction you made here is verified like 3 times already. So it's very secure. And the idea is that the more and more people use Bitcoin, the less and less likely of you getting hacked is. And if we go to the next slide, this is pretty much what a Bitcoin would look like. All this data you see on this right side is the history of transactions for this Bitcoin. And if you look up here, this is Bitcoin number 490,163. So basically, before this Bitcoin, there were that many Bitcoins mined, and this is that number of Bitcoin. And these are all the transactions that have gone through on this one block. And 2 other numbers to look at here are obviously the hash and the reward. And so you might be wondering, how is Bitcoin created, and where does Bitcoin really come from? Well, this gets us into crypto mining, and Bitcoin mining specifically. So if you look at the reward, it says 13.9 Bitcoin. So in Bitcoin, there are people called miners, well, computers called miners, that their job is to mine each block of Bitcoin. And what that means is basically they have to find the hash or a certain number for your block. And every block that they mine, they'll get a reward of Bitcoin. And then they use that Bitcoin in order to trade with other people, because that's where the source of Bitcoin comes from.
So I know with stocks, there's shares outstanding, a specific cap, the number of shares distributed. Is there something like that with Bitcoin?
Yeah, there is. If we go to the next slide, there's some visuals that'll help with that. And with Bitcoin mining, so Bitcoin was made with the intention of having a limit. So by the year 2140, all 21 million Bitcoin will have been mined and circulated throughout the economy. And if you look at this graph, this number is the reward for each block of Bitcoin mined. So at the beginning, you gain 50 Bitcoin, and every about almost 40 years, the number of Bitcoin you get halves, and eventually it'll reach 0 in 2040. That means no new Bitcoin will be circulated. This means that Bitcoin is deflationary. So once it reaches a certain level, there's going to be no more Bitcoin, and there's no more room for the price to grow. And you might be wondering, what's the future of Bitcoin, and like what's going to happen to Bitcoin after that? And honestly, a lot of people are wondering the same thing, because in order for Bitcoin to keep growing and adding more and more of it to its circulation, they're going to have to revamp the entire code base, essentially. They have to come up with a new strategy of creating Bitcoin. And this is just a graph of how much Bitcoin is in circulation right now. So right now we're about 19 million up here, and obviously in 2140 we're going to be done mining Bitcoin. And another thing to note is that every day only 14 Bitcoin are mined for like right now. And every year passes, there's going to be less and less Bitcoin that are able to be mined. And unless you own every single Bitcoin mining machine in the world, you can't mine 14 Bitcoin, because there's pretty much a math formula that limits the amount of Bitcoin that's able to be mined every day. That way it reaches 21 million in 2140.
So how hard is it to mine for Bitcoin? Can the average investor just plug up their computer and mine for it? Because if you're rewarded 1.56 Bitcoin per block you mine, that's like over $150,000. That's pretty good money.
Yeah. So that's a great question. So the short answer is yes, you can mine from your computer, but it is incredibly inefficient. People have whole setups, like people will rent out a whole warehouse and just fill it with computers, focus on solely mining Bitcoin. This is because there's a limited amount of Bitcoin to be mined every day. So even if you have a bunch of computers, you're not able to mine more than the maximum amount of 14. And most personal computers or even individuals are only able to mine small fractions of this. So back then, maybe a few years ago, it was probably really profitable when there's a lot of Bitcoin to be mined. But as years go on, there's going to be less and less to be mined. So the Bitcoin mining industry it's going to be hard to see a lot of growth in that area.
Yeah, I read somewhere online about the significant environmental impact from mining Bitcoin. Since you have all these thousands of processors and computers to mine these Bitcoin, it has a significant environmental impact. Some people try to stay away from crypto just because of the environmental consequences. So let's take a look at why is crypto doing so well. There are a couple reasons. Let's start with Bitcoin ETFs. This year we saw Bitcoin ETFs be passed, I believe in January, and this just gives more exposure to trading crypto. Now you can trade on traditional stock exchanges, so through your Robinhood or Charles Schwab, Fidelity, whatever, you can trade Bitcoin ETFs. So this gives more exposure. It also helps diversify. Maybe you don't want just exposure to one crypto, you're getting exposure to a whole basket of crypto like an ETF. It's also the concept of regulated ETFs versus the risks and uncertainties of cryptocurrency exchanges. So now with the Bitcoin ETFs, these are regulated. So there's that risk that's avoided from using cryptocurrency exchanges. Now we have the Fed rate cuts. We saw the impact of the rate cut in a good economy on the stock market. It was obviously a very positive reaction. We saw the stocks go up the day after the interest rates were cut. It's a similar thing with crypto. When interest rates are cut, investors can get loans for cheaper. With that loan, they can reinvest it into crypto, thus driving the price higher. So in the past, we've seen that rate cuts have had a positive impact on the Bitcoin price. So in the future, with the Fed rate cuts, maybe in December, maybe next year, that could also be another bullish sign for crypto. And then just bullish macroeconomic indicators. We know Bitcoin or crypto is a hedge against inflation, but it still matches these bullish macroeconomic indicators. When the economy is doing well, people will have more money to invest in things, in different assets like crypto.
And another factor to consider of why crypto is doing so well is Trump's presidency. So Trump has said multiple times that he wants the US to be the crypto capital of the world. And obviously that's good news for crypto, especially in the US. So that's obviously leading investors to be a little more bullish about crypto. And another thing is that one of his side projects right now is the World Liberty Financial, which is WFLI, which is his own, it's like his own cryptocurrency. And if your president is making his own cryptocurrency and getting involved in this, surely it's a good sign for the economy and other people are bound to hop on the wagon. And another thing, he's proposed to eliminate taxes on all US made crypto. Now this is huge because a large thing about cryptocurrencies is that there's a lot of taxes involved with spending it. Because when you own a crypto and the price goes up, you have to pay for every exchange that you use because it's technically worth more now, and so you gain profits. And so by Trump proposing to eliminate taxes on US made crypto, it's definitely going to boost the market, and obviously if it passes, but it'll give good signs for investors that are trying to get into crypto as well.
Yeah, year to date, we saw some impact from the Bitcoin ETFs and the Fed rate cuts. In the past 2 weeks, those crazy returns you saw, it's all from Trump's administration. So those past 2 weeks, the crazy 20%, 30% returns, this is due to Trump being elected as president. So let's look at some risks and benefits with crypto. The first and the main risk is price volatility. This is a risk a lot of investors are not willing to take. Crypto is traded 24/7, 365 days a year. And this price volatility is so extreme that your portfolio is fluctuating by large margins. Obviously, we saw a graph of Bitcoin. It's like this. It's crazy. It's up, down, up, down, up, down, bullish, bearish. We don't know anything about it. Right now, obviously, we're in a huge upward trend. Who knows where we are a couple months from now? We saw Bitcoin reach all-time highs, I think, like a couple years ago, 2022. It dropped drastically, and now it's back up to all-time highs. But there's huge price volatility. A lot of investors are not willing to take that risk, seeing their portfolio lose large amounts in one day and then gain large amounts the next day. These old investors, maybe the grandparents, they might not be as risk tolerant. They might not have such high risk tolerance. So maybe they don't want to see this huge price volatility. Maybe some young guys like us are okay with that. We have a lot more time to recover from our losses. There's also regulatory risks.
And the big thing about crypto is that it's focused on decentralization. And so this is a problem because if crypto wants to become big and more used in the United States, especially, the government's going to have to get involved. And that really counteracts with the idea of a decentralized currency. And if the government gets involved, people don't know what kind of regulations they're going to have to put for crypto. How are they going to manage it while keeping it free and unregulated? So that's always a big topic because we don't know what the government's going to do, and if they do take action, it might harm the price of Bitcoin by a lot.
Yeah, and then there's market immaturity. Just going back to every market reaction is an overreaction. These prices can be easily manipulated. We saw with Trump's administration, almost all crypto's up crazy 20, 30%. These prices are easily manipulated. Maybe some bad news, but any big investor, any big name, and these prices could fall drastically. So they're easily manipulated, not as easily as stocks. Far more easily than stocks. So let's look at the benefits. High return potential, I think this is a given. All of us probably regret not investing in Bitcoin in like 2014. We could all be college dropouts, retired, life would be very easy. So there's obviously high return potential, but that's with everything, right? I could have invested in NVIDIA a couple years ago, had the same thing, drop out of college, not be running PPM Club, life would be very easy. That's not the case for most people. You can't really see the future, so it's very hard to tell. Obviously, Bitcoin has been doing phenomenal this year. It's up 100%. NVIDIA's up 200%. So there is always that factor. Portfolio diversification. Maybe you don't want to hold all your assets in stocks or bonds. Now you can diversify it more by holding some into crypto. Because of this price volatility, since it fluctuates so much, the general consensus is you probably don't want to hold more than 5% of your portfolio in crypto. So less than 5% of your portfolio weight should be in crypto. That 5% benchmark is there because if you lose all 5%, it's not that big of a loss. So if you invest in some meme coin and it goes to nothing, it's probably not that big of a loss. But if that meme coin skyrockets 1,000%, it's still really, really good returns. So that less than 5% consensus is there for those risky assets. And then growth opportunities. This is still a relatively new sector, so there are a lot of growth opportunities. We obviously saw that Max mentioned with Trump's administration, there's a lot of potential for crypto, and that's why it's been so bullish in the past couple of weeks. So it'll be interesting to see how it goes in the future. But this price volatility, this market immaturity, regulatory risks, these are some of the main reasons that investors are avoiding crypto investments. But there is also the factor of super high return potential.
Do you think it's realistic for the average person for crypto? Because there's often rug pulls in them, so there's not really like, I guess, a way for the average person to really benefit from it. What if it's like not those people on it 24/7?
I think it's just like any other asset. You can buy and hold. Like I could buy Bitcoin a couple of years ago. I hold it and it'd be up a couple 100%. It's just similar to a stock. It's just a little more volatile. There's no specific market hours, so after 3 p.m. you can't rest. This price of Bitcoin might fall significantly. So I think it is relative to some other asset you might hold. Any investor could hold it as long as they open a Coinbase account, or even now with these Bitcoin ETFs.
And I also think that, especially like if you talk about Bitcoin, Bitcoin is a little bit more reputable and well known. But especially with those small meme coins, there's nothing backing them, right? There's no fundamental, like I like what we said, fundamental analysis. There's no fundamentals backing these meme coins. There's nothing that's going to turn these meme coins into something. There's no guarantee that they're going to be usable or valuable in the future. Like with Bitcoin, we can see people like Trump and governments begin to allow more usage of Bitcoin. But if you were to go to like Starbucks and say, "Can I pay you in Dogecoin?" Like that's really not gonna fly. But yeah, it's just there's nothing to support small meme coins. So you're taking a lot of risk for I guess a lot of return, but you know, there's nothing that's gonna guarantee you to do well in the future.
Yeah, so with that being said, let's now transition into fundamental analysis. We're super close to being finished. Obviously, we went through the Finviz stock screener, so a screener that helps you filter out those stocks and choose specific criteria that you're looking for. We looked at the business details last time, so those 10K annual reports, how can we decipher those, what do those mean? And the financials, the income statements, the balance sheets, the cash flow statements, all that boring shit you learn in accounting. But now today, let's look at the strategy and the stock valuation. So what is the company, or what is the management of a company doing to grow the business? And then is this company overvalued, is it undervalued, is it fairly valued? So let's look at the strategy. It all goes back to the annual reports we discussed last time. In those 10K reports, you can see the capital expenditures. What is this company spending on their investments? Here's Apple. You can see that in their annual report, this year they released a new MacBook Pro, the MacBook Pro 16-inch, the MacBook Air, whatever. So they're investing and growing through all these new platforms and new products. There's also the earnings calls. I don't know, have any of y'all joined an earnings call before? You joined one? Yeah. So within an earnings call, you can listen to the top management, the CEOs or the C-suite executives talk about the business. They'll give a brief overview of the business, how the business performed in that quarter, and the most important thing, which I personally prefer listening to, is the Q&A. So anyone can join these earnings calls and ask any questions they may have. So if I have a question about Apple, why have your sales in China been so low? I can ask, well, I probably can ask that, but someone else can ask that to the C-suite executives. So that Q&A is a really important part to learn about the company's strategy. You get the top investors' insight into what they're looking for in regards to the company's growth and strategy. So NVIDIA actually has their earnings call this Wednesday. I believe it's after the market close, so around 3:30. You can actually tune into NVIDIA's earnings call and listen to those updates on the Blackwell chip or the Trump's tariffs. I'm sure some people will ask about that. So those earnings calls are a great way to learn about the company's strategy. And then mergers and acquisitions. I don't know if anyone's interested in investment banking or the legal side of M&A, but you can always look at what is the company doing to grow? Are they acquiring new businesses? If you look at this table on the right, these are Apple's the 10 largest acquisitions. So I don't know how many people are even familiar that Apple is involved in M&A, but you probably heard of some of these, Beats or Shazam. These are some of Apple's acquisitions that are helping them take their company to the next level. Obviously, the company is really good right now. We know it's a great company, do we know it's going to be a great company in the next 5-10 years? So these acquisitions are really important to tell us, okay, Apple is acquiring these new companies so they can expand their business and get these new technologies to grow their business in the future. So you can look at the M&A to figure out what the strategy or what the management is doing to grow in the future. And then with that comes the stock valuation. Stock valuation is really important, but it's not the most important thing. It's step 5 for a reason. So now we determine, so with fundamental analysis, we're trying to buy a great company at a great price, right? It's understanding the underlying business. What is the intrinsic value, or what is our interpretation of the value of a company, right? Just because the share price of Apple's $230, does that mean it's actually valued at $230? It might not be, because it might be overvalued. So we're trying to buy a great company at a great price. We've already determined through steps 1 through 4 that this is a great company. Using the stock screener, looking at the annual reports, looking at the financials. We know that Apple is a great company. Now do we know, is it at a great price right now? Because if it's a great company, but it's extremely overvalued, do we want to buy it right now? So that's where stock valuation comes into play. We determine it's a great company. Now we're to determine, do we want to buy it right now? Do we want to wait for the price to fall a little in the future? What do we want to do? So what do we mean by this? I don't know how many of y'all follow Tesla stock, but Tesla is up close to 100% in the last 6 months. Following Trump's election, Tesla shot up. So the main question is Tesla overvalued? I'm going to walk you through how I would approach this. There are 4 things I look at. If any of y'all are finance majors or accounting majors, you've probably seen some of these terms. The price to earnings ratio, the price to earnings growth ratio, enterprise value to earnings before interest, taxes, depreciation, amortization, and then insider shares. These are a bunch of ratios. I don't know who remembers the lecture we gave on FinViz, the stock screener. I said it's useless to put valuation metrics in a stock screener. Does anyone know why? Because when you enter valuation metrics, you have to compare it to companies in that sector. So PE under 30 means nothing if it's very far off from companies in that sector, or if companies from that sector have a lower PE. You have to compare that, those ratios to companies in that sector. So let's do a little deeper dive into this. So what's the PE ratio? So you take the share price, so say Tesla's what, $320 a share, divided by the earnings per share. How much are they earning per share? With the PE, there's 2 types. There's the forward PE and there's a trailing PE. The forward PE is the expected earnings in the next 12 months. So you're forecasting the earnings. And then the trailing PE is the historical earnings. So what are the earnings per share in the last 12 months? Investors prefer a PE ratio as low as possible. So when you're trying to value a stock, you want this ratio to be as low as possible. So you want their earnings per share to replicate almost what the share price is. 10 is the benchmark. So investors want a share price that's 10 times greater than the current earnings per share. Next, we have the PEG ratio. Now, some companies might have a really high PE, but they're growing by an exponential amount. So we'll take a look at some of those in the future. But for example, Rivian is one example. Their PE is not very good. In fact, it's negative. I'll show you that in a bit. But their PEG is a little better because they're growing at a significant amount. These are growth stocks. You've probably heard of value stocks and growth stocks. The PEG comes into play for the growth stocks. So it takes the PE ratio divided by the earnings per share growth rate. So a PEG ratio of 1 is fairly valued, and if it's below 1, it's undervalued. So you can look at these metrics on Yahoo Finance. You can see PE. 10 is the benchmark for the PE. 1 is the benchmark for the PEG. Let's look at the enterprise value divided by the earnings before interest, tax, depreciation, amortization. I don't know if any of y'all have worked in finance before or worked in internship. EBITDA is a common metric that every company uses. Some companies have different operating or non-operating expenses, so you may have different tax rates or may have different depreciation rates. EBITDA accounts for all of that. So it just takes the earnings minus the interest, tax, depreciation, and amortization to to get you a relative number that doesn't account for those non-operating expenses. So we take the enterprise value divided by that to determine another ratio with a benchmark of 10. So let's look at Tesla's example. Here on Yahoo Finance, I pulled up these different ratios. We have the trailing PE and the forward PE, both around 90. So remember, we said the benchmark was 10, theirs is 90. Now let's look at the PEG. 9.15. The benchmark was 1, theirs is 9.15. EV to EBITDA, 73. Benchmark was 10, theirs is 73. Now remember I said this doesn't really mean anything unless we compare it to stocks or companies in the same sector. Well, the EV sector in the United States is a really bad sector because all of Tesla's competitors are actually operating at a net loss. So if you look at Rivian, for example, they are losing money on every car they produce. So their earnings per share is actually negative. And if you look, they don't have a PE ratio, they don't have a PEG ratio, their EV to EBITDA is actually negative because their earnings per share is negative. So they're losing money, and that's why this is kind of a bad example. But you could still tell this is significantly overvalued, and it just shot up completely with news of Trump's administration. Now this is an interesting case. Tesla's obviously a very established and reputable company. But we'll be curious to see how will this earnings per share be impacted in the future under Trump's administration. Will these ratios be lowered in the next earnings call or in the future earnings call because Tesla will now be making more money? So that will definitely be something to keep an eye out for. One thing you might see among all the top companies is, it's called the Magnificent Seven. I think I described it to you earlier, but it's basically all the top tech companies in the United States. They all have relatively high ratios. And why is that? These are large, reputable companies. So investors are willing to pay a premium today for potential strong earnings growth in the future. These companies are reputable. They're strong companies with great profits, great earnings. They're going to continue growing in the future. Remember, we did fundamental analysis. We know that all of these companies are great companies. They're the top 7 tech companies in the United States. That's no small thing. That's a really big thing. So investors are willing to pay a little more right now because they're expecting that growth in the future. With smaller companies, you can't expect that because we don't know that they're going to get that strong earnings growth in the future. So valuation is important with that. With these large, reputable companies, maybe just a buy and hold strategy is the move. These are long-term investments, so it doesn't matter if $2 or $3 really make an impact in 20 years. Right? It's kind of like investing in the S&P. I just say buy, buy, buy. No matter for an all-time high, no matter if the markets are down, buy, buy, buy. These are long-term investments, so how much does valuation really matter in that aspect? Maybe with the smaller companies or the smaller caps, you really want to focus on the valuation. With these large, reputable companies, if they're long-term investments, buy, buy, buy. That's the strategy. And then the last thing is insider shares. So I couldn't really find a good example of Tesla. I haven't seen anything in the news of Elon Musk buying or selling Tesla shares recently. Maybe some of y'all know something that I don't. But I found an example of Apple. So Apple CEO Tim Cook actually sold out over $50 million in stock amid their performance evaluations. So if Apple CEO is shredding $50 million of shares, that might raise concerns for the average investor. If the CEO, the top dog, is selling some of his shares because of their performance evaluations, maybe he sees this as a bearish sign for the company in the short term. Obviously, Apple is a reputable company. In the long term, we'll see strong earnings growth. In the short term, maybe that might not be the case. I saw an example of Amazon. I don't know how many of y'all are familiar with Amazon's share price, but it's hovering around that 200 range, and it has been for the last several months. This is mainly due to the fact that Amazon CEO Jeff Bezos, every time the share price reaches $200, he's selling shares. So the second that share price reaches $200, he's shredding some of his portfolio. It's really hard for Amazon to break past that 200 share price because their top dog, the guy that holds most of their shares, is selling it right when they get to that 200 mark. So not only is that fearful for investors, but it's also bad for the stock price, because when he sells it, the stock goes down because he owns such a large majority of those shares. So looking at these insider shares is important, but it's not everything. It's like tracking the politicians' trades. You can track it, they get good returns, but it's not everything. You want to have your own strategy as well. So with all these things considered, it's your decision whether you want to buy Tesla or not, but we have determined that Tesla is probably pretty overvalued, as most of the people in America or in the world know. So that wraps up fundamental analysis. We use FinViz, so we use that stock screener to determine those basket of stocks using that specific criteria. Then we looked at the annual reports. We looked at the 10K reports. We understood that. What do those mean? What is management doing to grow in the future? We looked at the financials, the income statements, the balance sheets, the cash flow statements. We looked at the strategy. What are the capital expenditures? How is management doing? And then finally, with all of those factors considered, we looked at the stock valuation. So we determined the company is a great company using these first 4 steps, and then we determined it's a great price using the stock valuation. So that wraps up fundamental analysis. That's a strategy we're going to build on throughout the next several semesters. It's a strategy Warren Buffett uses. Almost every big investor you've ever heard of, they use fundamental analysis. They've just mastered this strategy. But it's a strategy I highly, highly recommend researching, practicing. It's the best value investing strategy. You'll find a lot of books on this, but this is the broad overview of fundamental analysis. Any questions? I know that was a lot. Okay, so next week we have some pretty exciting stuff. If you absolutely know nothing about investing, we're doing a complete beginner's guide to investing. So how to open a brokerage account, how to buy stocks, how to sell stocks. If you're really interested in opening a brokerage account, getting started on those basic things, next week we're going to be hosting that. And we're also going to be talking about our events for next semester. So we have a lot of really, really creative stuff planned for next semester. This semester was kind of a do as it goes. I didn't expect PPM Club to be formed this semester. I actually thought of this idea in like July of this year, and then somehow we got it formed. So it's kind of like figure it out as we go. We have a pretty good plan planned out for next semester, and we're going to be discussing some of that stuff next week. So I highly, highly recommend coming out to that meeting. It's going to be a good establishment for next semester. All right, thanks for coming out.
Can you guys all fill the